Folks, I'd like to call to order this Retirement System Investment Commission meeting for Thursday, September 8th, 2022. Before we get started, I'd like to ask our CEO, do we have any housekeeping items, anything to adjustments to the agenda, or otherwise announcements that you'd like to make?
Thank you, Mr. Chairman. I think it would be appropriate at this time before we get started to, as we can see around the table, we have some new faces for the first time in a while. And I think we'll introduce people along the way, but I think it would be most appropriate to take a moment to formally introduce our two new commissioners that we have with us, Dr. Holly Ulbrich and Ken Dion. And if I may, Dr. Holly Ulbrich is an alumni distinguished professor emerita of economics at Clemson University. She holds a bachelor's and master's degrees and a PhD in economics from the University of Connecticut, and a Master of Theological Studies from Emory University. Dr. Ulbricht's area of specialization is state and local public finance, and her research focused on applied issues in taxation, budgeting, and education finance. She is the author of 15 books, including textbooks in public finance and introductory economics. So welcome, Dr. Ulbrich.
Thank you, Michael.
Also, I'd take the opportunity to introduce Mr. Ken Dion. Mr. Kenneth D. Dion is a CPA and a retired partner with KPMG's audit practice, where he devoted his career primarily serving large state and local governments. He also provided audit and advisory services to higher education institutions, power and energy, and middle market growth companies. Mr. Dion was a lead partner and managed large, complex financial and compliant audit engagements in accordance with OMB Circular A-133. I'm sure everybody knows what that is. Well, the great thing is, I feel like at least 5 of you do, right? To several entities, the rest of us, we don't know. To several entities, which included the states of New York, Vermont, New Hampshire, South Carolina, and the universities of Miami and Syracuse. In his career, he served as KPMG's Albany, New York, and Burlington, Vermont offices managing partner from 2004 through 2015. He also spent 10 years in the firm's Southeast region, where he served as the partner in charge of the South Florida government practice and served as the office managing partner of the West Palm Beach, Florida office from 2001 to 2004. Since retiring from KPMG, Mr. Dion has provided expert consulting services and recently worked as an adjunct lecturer in accounting at the University of Colorado at Boulder. He is also a recent graduate of the Masters of Accounting program at some university, it's called, I think it's Clemson, which several of you are also familiar with. I've heard of this Clemson University.
Becoming a majority.
Very concerningly becoming the majority. Mr. Dion is currently serving as the acting chief financial officer of the Executive of Labor and Workforce Development for the Commonwealth of Massachusetts. So, welcome, Mr. Dion.
And I am retired also.
Somewhere in there.
Somewhere, yes. That was in there somewhere that you retired, and then I said about 50 other things that you're doing. So you're enjoying a nice, quiet retirement. So, I believe that is all that I have at this point before you would officially call the meeting to order, Mr. Chairman.
All right, so welcome new members. Glad to have you aboard. So officially now calling it to order. First item up is the adoption of the proposed agenda. You all have had this in your possession for a while. I'd like to call for a motion to adopt the agenda that's been put before us today.
So moved.
I will make the motion.
I have a motion from Mr. Condon, and I'll take your, Mr. Giobbe, as a second. Any discussion before we proceed? All in favor of adopting the proposed agenda, please say aye.
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 All opposed, no. The ayes carry. We have an agenda. Also, next, the minutes for the June 2nd, 2022 meeting of this commission have been sent out to everybody. I hope you all had a chance to review those. I have no suggested changes to them, and so I would call for a motion to approve these.
So moved.
I have a motion to approve the minutes from the June 22nd meeting. May I have a second?
Second.
I have a motion and a second. Is there any discussion on the minutes from the June 2nd, 2022 meeting? Hearing none, I'll call the vote. All in favor of approving the minutes, please say aye.
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 All opposed, no. The ayes have it. We have approved minutes now. All right. Next up, I'm going to turn it over to our CEO for some more introductions.
More introductions, yes, sir. Thank you, Mr. Chairman. As we can see, we also have more new faces. We have Mr. Mark Brubaker and Mr. Mike Patowski from Verus with us. As everyone knows, we engaged back in the spring in a consultant search for a new general investment consultant. Verus was selected by the commission as our new investment consultant, and our consulting team is most ably filled by Mr. Brubaker and Mr. Patowski. So we thought it would be appropriate to give them an opportunity to introduce themselves. I could read your bios, but I feel like you could probably handle that yourself. So Mark, I'll turn it over to you.
All right, well, great, and thank you, Mike, and thank you, Mr. Chair, and I wanted to start by thanking all of you for the confidence you placed in Verus and in Mike and me to be working with you going forward as your investment advisor. We're really excited to get going on that. Maybe just a real quick background on myself. I know we had one-on-one conversations with each of you, so I'll try not to be repetitive, but I've been in the industry for over 32 years now. My background, I don't have a Clemson or University of South Carolina background, but I graduated from Yale University, have my MBA from Carnegie Mellon University, and Mike and I are both based out of Pittsburgh, which is part of the Carnegie Mellon connection there. Prior to joining Verus, I'd spent most of my career at a competitor firm called Wilshire Associates. Spent 22 years there. I served on their board of directors there. I also ran their outsourced chief investment officer business while I was there. Joined Verus back in May of 2020 to build an East Coast presence for the firm. Verus is headquartered in Seattle. We've been around for a long time, since the mid-1980s. But all of our offices had been located on the West Coast. Seattle, we have another office in San Francisco and one in Los Angeles. But we had a significant portion of our clients, over a third of our clients were east of the Mississippi. So in 2020, they hired me and one of my colleagues, Ted Herman, to start a Pittsburgh office. Mike joined us shortly thereafter. We're now up to 5 people in Pittsburgh, and we have a number of clients that we work with on the East Coast. Our team in particular, we work with Indiana PERS, West Virginia Investment Management Board, Tennessee Consolidated, and the Pennsylvania Public School Employees Retirement System. So we work with a lot of clients very much like you, but we also work with clients that that are different in some ways. We work with endowments and foundations. We work with corporate pension funds, and we think that's important because we can bring a lot of what we learn working with those types of clients to the table when working with you, and vice versa. A lot of what we learn working with clients like RSIC, we can apply to the work that we do with other clients as well. As you probably know, our primary role going forward with RSIC is going to be primarily with respect to governance, investment policy development, asset allocation, and asset liability work, as well as performance reporting on an ongoing basis. And kind of interwoven with all of those will be education. So to the extent, and I think I mentioned this on most of our one-on-ones, but to the extent that there's anything, any topic where you say, hey, I need to learn more, and whether we do it on a one-on-one basis or whether we do a formal presentation to the commissioners, that's what we're here for. So I would encourage all of you to be vocal. Let us know what you need from us, and if you're not getting what you need from us, by all means, let us know. But we're excited to be working with you, and look forward to getting started.
Thanks, Mark. My name is Mike Patowski. Just want to echo Mark's comments at the beginning here that we're really excited to begin working with you. Just by way of background, so I've been in the industry for 23 years now. I have an undergraduate degree in finance from University of Notre Dame and a master's degree in MBA from Carnegie Mellon University. Spent most of my career on the consulting side, so I've been doing consulting for about 20 years now. I've at various places, so I joined Mark about a year ago here at Verus. Prior to Verus, I worked for about 6.5 years at Willis Towers Watson. And then prior to that, for about 10 years at Wilshire Associates, and that's where Mark and I worked together as a team for that period of time. I know we sound like a radio show, Mike and Mark in the morning. Mike and Mark, yeah.
Mike and Mark in the morning.
And I also spent time earlier in my career managing assets. I was working for a company in Pittsburgh called PPG Industries, managing their pension and 401k assets, which at that time totaled about $5 billion in total. And I also had some foundation and other subsidiary plans and things of that nature. Over my career, I've worked with many different types of investors and pools of assets, public pension plans like this, corporate pensions, endowments and foundations. And so I have a broad experience across all these various asset pools. So again, very excited to get working with you and look forward to a good relationship here in the future.
Thank you, Mike. Next up is the chair's report. And I believe the next order of business is for this commission to elect chair and vice chair for the next, I believe it's a 2-year term.
Yeah,
Mike, how about lead us on that? if you don't
Yeah,
mind?
Mr. Chairman, I think, in talking with folks kind of in the interim, we carried over the chair and vice chair elections and the committee selections in June to this meeting, or basically just carried them forward, or carried them over. I think that there's at least a consensus that we would allow, or that you would allow Ken and Holly an opportunity to experience their first meeting, get to know everybody at this meeting, and then, revisit this at the December meeting. If that is the case, what I would ask commissioners to do, I'm going to send out an email to all the commissioners asking about committee assignments and whether or not you would, any interest that you would have in serving on a committee, because as of right now, we still have, you appointed Missy to Commissioner Schumpert on an interim basis on HRCC, but we still have a vacancy on audit. So, I think that'll give us some time to make sure that we have a slate of committee members to bring to the commission in December. But it was my understanding from talking to everybody that there was a consensus to just carry this over until December.
All right, any comments on Mr. Hitchcock's suggestion to carry this over? All right, hearing none, let's move along to the next piece of business here, and that is committee reports.
Yes, sir. And I believe that the committee report for the audit committee was posted. And the general practice has been, if there are any questions, that those can be directed to one of the chair or one of the members of the committee. So if there's any questions about the audit committee report, sorry. And also,
Hearing none?
oh, sorry, go.
Hearing none, move to the next committee.
Yes, sir, Mr. Chairman. The Human Resources Committee met last Friday and received information that the committee is required to receive as part of its oversight function regarding the variable compensation program, as well as staffing changes and compensation changes over the course of the ensuing time period since the previous meeting, as also in compliance with the charter. If there's any specific questions about any of that, we could certainly take those up, but those would probably be better served in executive session.
I plan, fellow commissioners, I plan on, if you will, opening up the floor in executive session to discuss detailed information that might have gone around during this, the Human Resources and Compensation Committee meeting. There was some very detailed information shared and discussed about specific individuals and compensation amounts, performance reviews and things of that nature that we must keep confidential. And if for some reason I don't come to that, I don't see that on the agenda for executive session. If I don't come to that, please, someone feel free to remind me that we'll need to circle back to that.
We could potentially work that in
Okay.
item G, which is the CIO.
But as long as everyone gets a chance to ask whatever they'd like.
Yes, sir.
All right, next up is the CEO's report. Again, I'm gonna turn it over to you, Mike.
Thank you, Mr. Chairman, and just a couple of more introductions, and I believe after that, we'll have everybody introduced. So the first introduction I'd like to make is Sally Fulkert, in the back row here. Sally has joined us as our new HR director. I think most everybody knows that Brittany Story, who was our previous HR director, left us for a fantastic opportunity in the private sector. And we were very fortunate to find Sally and very fortunate that she agreed to come serve in the role as Human Resources Director. Just to give you a little bit of her background, Sally comes to us from the Darla Moore School, where she most recently served as the Director of Employer Relations and led the school's efforts to enlist businesses to recruit students for internships and full-time positions. Previously, she served as the Managing Director of the Masters of Human Resource Program at the Business School. And in that position also taught a couple of finance classes to HR, Masters in HR students. She also has extensive experience in various human resources and recruiting roles in the private sector prior to her time at USC. As I said, we feel truly fortunate to have someone with Sally's skill set and expertise joining us and assuming such a crucial role for the organization. So welcome, Sally. Also, we have Mr. Richard Foster. Richard, stand up so we can get a good look at you. That's my version of hazing associates. So just FYI. Richard joined RSIC's associate program in July of this year after earning an MBA and Masters of Science in Finance from the University of Utah. And while in graduate school, Richard served with the Utah School and Institutional Trust Funds Office. This office is established to manage funds for the benefit of Utah's public schools. Prior to graduate school, Richard was a senior financial consultant for Anthem. So welcome, Richard. Very happy to have you with us and look forward to great things as you move through our associate program. So,
Very good. Any more introductions?
I don't think so.
We got everybody? Okay.
My name's Michael Hitchcock.
I'd like to reintroduce myself.
Yeah, I attended what I would like to call what we call the Harvard of the Midlands, right across the street. Okay. It's Kudzu, yeah. Kudzu level school, not Ivy League, Kudzu League. So, anyway, moving on, this is the time of the year, Mr. Chair, when I present our annual budget recommendation to the commission for its approval, because we have to submit it to the governor's office, which begins the budget process for the 2023-2024 budget. So this would be the budget for next fiscal year, not the current fiscal year that we're in. And just as a reminder, especially for Dr. Albrecht and Mr. Dion's benefit, the general, just like every other state agency, the General Assembly, we fall into the state budget, and our budget is authorized by the General Assembly through their budget process. The one difference between our agencies and a lot of other state agencies is we are all what's considered to be other funds. We are not appropriated any general funds, so no direct tax dollars. And that, basically the General Assembly authorizes us to expend up to a certain amount of trust funds to operate our agency. So when I'm walking you through this budget presentation, this is the request to authorize an amount for us to operate the agency. So, first slide. This is our organizational chart. I think many of you have seen a version of this. We currently have a few vacant positions that one of the first orders of business for Sally will be to recruit for. We have a private equity officer vacancy that we'll be recruiting for. I think many of you know Josh Rastari, who was a member of our associate program and also had joined us as a permanent full-time staffer. He left us about a month ago to go to Boston to work for an OCIO firm up there. So he was helping us manage our co-investment program. So we'll be looking for his replacement. We are going to have a new junior analyst in our reporting department. So we'll be recruiting for that as well. And then, as always, we're constantly recruiting in the investment associate program every year because of the churn that just naturally occurs as a result of that. This is give you a sense of our appropriation history. Back in fiscal year 17, we asked for an increase in our authorization, and then immediately the next year asked for a decrease in our authorization. So we were asked for a reduction in our authorization by $1.5 million. We subsequently in fiscal year 20 asked for an additional decrease in our authorization of $500,000. I can tell you, when you go to a budget subcommittee hearing and you're asking for a decrease in authorizations, you get interesting looks. And sometimes interesting looks when you just ask for the same amount, which we did have done basically every fiscal year since fiscal year 2020. For this year, we're asking for the same authorization amount again. So we're not asking for an increase or decrease in authorization, but simply the same amount that we asked for last year.
Mike, this is Ed.
Yes, sir.
What accounted for that sharp drop in fiscal 2017 and the next year? What decreased?
We decided that we really didn't need that much authorization, Ed. That was back when we were thinking about, doing internal management. So, think about us internally managing the equity portfolio. And we were, trying to build up authorization in order to be able to implement that. That is ultimately not a direction that we decided to go to. Obviously, we've gone in a complete opposite direction as to where we find ourselves now. So that was really just a representation of us not pursuing that initiative anymore and bringing our authorization more in line with, the reasonable expectation of what we thought our expenditures would be.
Mike, what was your actual expenditures for fiscal 2023?
That's a great question.
Didn't see
and I
that
had
on the
that.
slide.
Yeah.
$12.2 million for the
Okay.
fiscal year that just ended in June.
Okay.
And we would expect for that to go up for the fiscal year that we're in, and that's basically the reasoning there. We do have some open FTE positions that we need to fill. We've felt the impact of our recently implemented variable compensation plan. And we do have costs. The fiduciary audit that we're doing, that Funston is doing for us right now, that actually, even though that engagement is through the state auditor's office, statutorily, it comes from our budget amount. So that's the additional authorization or the additional expenditures that we would have for this year. I will say that we would anticipate, we're not asking for any additional authorization this year. We are moving $200,000, and I'll show you the detail. $200,000 from other operating expense. This is basically the lines of our budget. So we're moving $200,000 from other operating expenses to employee contributions. And that's just a representation of the increased costs associated with that because those in essence represent a percentage of salary. And as we've absorbed the cost of living increases over the past couple of years, that also has a corresponding impact on employer contributions as well. We believe that we'll be fine at the authorization amount that we have for this fiscal year, but we may be looking to ask for an increase in authorization next fiscal when we're doing the budget for the fiscal year, the following fiscal year, so the FY25 budget. And I will bring, if I'm asking for additional authorization, I'll bring a significant amount more detail in that regard to the commission before to justify the increase in authorization. So these are basically the three main lines of our budget: personal services, other operating, and employer contributions. The total's the same. We're just moving a little bit of money around. Again, in summary, we're requesting the same amount as we did in 22-23. We're not requesting any additional FTEs. We're planning to fill some of the vacant FTEs that we have But I'm trying to move us to a strategy of doing more with less, and being leaner and being able to provide folks with competitive compensation so that we can keep good employees rather than hiring more people and having more turnover. Because we're authorized 51 full-time positions. Currently, we have 39 of those filled. We're probably going to recruit another 5 over the course of the year. But so we don't expect to in any way get close to filling or bumping up against the maximum amount of FTEs that we have authorized.
Mike, again. Mike, a question. The maximum available positions of 12 seems quite a lot in relation to the authorized number. Is this affecting our ability to operate at all?
Not at all, Ed. And like I said, I would rather us have a, forgive the euphemism, but a leaner, meaner staff that we can compensate in a way that's competitive rather than, filling all of those positions and having more turnover. But no, it's not impacting our ability to operate at all. Scott?
Yeah, and that's probably part of the answer to my question. You don't have to go back to it, but thinking about the organization chart, there was only 3 vacancies, but this kind of indicates maybe there should be 12 vacancies.
Well, that's the maximum amount of positions that we have authorized. That doesn't necessarily mean that we have to fill those.
Right.
Yeah. So, just to give us, I've never necessarily considered giving back, even though I've given back authorization, I haven't necessarily considered giving back FTEs, just because I like to have the flexibility. So if we were to take on some additional, I can't necessarily always predict where we may need folks. And it's a lot easier just to have those positions available if we need them. But right now, we don't find ourselves in a position where we need to fill 51 permanent full-time positions.
I know the prior Budgeting Control Board, so I would assume now the present SFAA has a process, and maybe every year where maybe they delete unused FTEs. Is that still happening? Are we at risk at that?
I don't think so. Yeah.
I saw that happen.
Yeah, we've held the same FTE head count for the whole time that I've been here. And we've never, I think the most that we've ever had or utilized was 45, I think, during that time. So and we're exempt from a lot of the same requirements that other state agencies have and, some of those rules. So, but that's never come up on our radar.
Okay, because certainly don't want to lose them.
Yeah, and like I said, it's, we don't really, it's not that we're ultimately, I try to be as good of a steward of trust funds as possible. We only take down what we need from the trust to operate. We're only have the staff that we feel is necessary to operate. But getting additional FTEs or changing that head count is almost as difficult, if not more difficult than asking for additional authorization. So it gives us a little bit of flexibility.
Mike, the authorized number of positions, who sets that authorization?
It's part of the budget process, Ed, so ultimately the General Assembly approves it. Like the maximum amount. And then me and, my executive team, within the constraints of the budget amounts, make the determination as to how many folks we actually need to employ at any one given time.
Which means if you need to increase it, you got to be thinking like 2 years ahead,
Right.
because of this long time frame.
Right.
So that's another reason we don't want to lose what we got.
Right, yeah, it's just built-in flexibility, because there could easily be something that I'm not necessarily anticipating, a function that we would need to take on. So having that built-in flexibility.
And we can't count on the General Assembly being willing to give additional positions depending on their own
Sure.
sense of constraint. It's
Sure,
it's sort of a safety valve.
Right, yeah, and also the the expenditures for last fiscal year were well below the authorization amount, but we also like to maintain that degree of flexibility as well, so.
Before we move on, I think it's worth noting, to those of you who have concerns that maybe we're not staffed well enough to carry out the mission, please keep in mind that over 50% of the portfolio is managed passively, so we don't have to have bodies and hands and punching keyboards every day to have that part managed. So I think that should add a little color to why it's appropriate to only carry, 39 or 40 rather than the maximum of 51.
Sure. And we did a few years ago, we had CEM, which is our benchmarking, which is the benchmarking service we use to benchmark our investment management fees. They also did a survey of, staffing, like a staffing survey. And it's basically, given your size, do you have the right number of staff, given what you do? And we were well within the degree of reasonableness as to how many folks we have versus how much money we manage. And I think, the simplification of the portfolio has also made this, where we have the staffing at now, a much more reasonable number of folks. And, as you can see from the org chart, most of the investment staff, for instance, is concentrated in, the asset classes, the alternative asset classes, because that's where we feel like that we can outperform.
Any more questions or discussions on, I'm sorry.
Oh, that's all right. Also, just so for everybody's information, make sure, and awareness, we have a proviso that has been in the budget, and, for Holly and Ken, and Holly, you may be more familiar with this necessarily, there's the numbers, there's the dollars in the budget, and then there's the part that really counts, which are the provisos, which tells you how to spend it. Now, this proviso doesn't tell us how to spend any money, but what it does do is it provides us with an exemption from the procurement code. So for us dealing with the Bank of New York Mellon, when it comes to the custodial services that they provide for us, so we don't have to go through the procurement process if we want to add or change a service that they provide. This exemption has allowed us to consolidate services with the Bank of New York at some pretty substantial savings. One of our risk system we now have is through the Bank of New York Mellon contract. We also, CAISA, which is our attribution system, is through the Bank of New York Mellon contract. But this has allowed us to consolidate services at a significant cost savings. So we always just ask the General Assembly to keep this proviso in, because of what it's done for us and our ability to be able to, again, to consolidate those services in a way that's financially beneficial to the trust.
Is there any possibility of making that permanent rather than relying on an annual proviso?
Well,
Just asking.
yeah, I always have a degree of hesitation to anything to
Upset the apple cart.
permanent, because,
Okay,
having been over there for a while,
yeah.
what starts out ain't necessarily what finishes, so,
Okay.
And that's all I have. So basically, Mr. Chairman, if I may, there's a motion in regards to the budget, and the motion is the commission authorizes the CEO to submit a proposed FY 2024 detailed budget substantially similar to the draft budget presented for inclusion in the governor's annual budget.
Call for a motion, please.
So moved.
May I have a second?
Second.
Do we have any more discussion or questions about the presentation we've just received from our CEO about the budget that he's requesting authorization for? Hearing none, all in favor, please say aye.
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 All opposed, no. Motion carries. We have a budget that you're approved to go get approved. I think next up is our report from our Chief Investment Officer, Mr. Jeffrey Berg. And I will turn it over to you, Mr. Berg.
Thank you, Mr. Chairman. I am going to walk you through the performance as of June 30th. And I, of course, want our new consultant to feel free to chime in at any point. And if you don't during, I'll make sure to create that opportunity at the end.
Great.
So, let's get started with the high-level performance details in what wound up being, thanks to a pretty awful market landscape so far in 2022, a negative return for the 12 months ending June. I'm pleased to report to you that we were able to outperform our benchmark quite meaningfully during the year. And you can see that toward the bottom. You can also see that we are, on a trailing basis, we are outperforming our benchmark over the last 3 and 5 years by a very nice margin, and also over 10 years as well. The other important detail on this page I want to point out is at the very bottom of the page, where you can see that our annualized net benefit payments are now $514 million. Some of you may recall several years back, prior to the pension reform legislation in 2017, if I'm not mistaken, that number had eclipsed $1 billion and was continually rising. So this is a very meaningful way that we're able to see the impact of pension reform. Now let's look at our performance framework. And just as a reminder, on this page, we summarize the impacts of different investment decisions that get made. And it probably is worthwhile for me to slow down here for just a second. The yellow boxes in the middle of the page are what I'm going to tailor my comments to, but they drive off of the differences between the top row. And let me just briefly articulate what that is. The reference portfolio is a simple 2-asset portfolio, 70% global equities, 30% investment grade bonds. That is the portfolio that we believe prospectively has roughly the same risk as our policy benchmark. Now, the policy benchmark is the target portfolio approved by the commission that is sort of sponsored by the consultant with, of course, input from the staff here as well. The implementation benchmark is where things start to get interesting. This is where we pick up the degree to which I am running our portfolio differently than that target portfolio. And then the plan return is, at the end of the day, the thing that matters most. This captures all of the decisions that we have made. And in the middle, you can see in the yellow boxes, the value from diversification picks up the difference between that simple 2-asset portfolio, which is the cheapest way to invest at a given level of risk, and the target portfolio adopted by the commission. So what are we picking up? We're picking up the value from employing a more diversified approach. And the quality of portfolio structure, those are the decisions I alluded to, where I run the portfolio differently in a top-down sense than that target portfolio. And we'll get into those decisions in a moment. And then the quality of manager selection, we have a staff that decides which managers are going to manage the money on behalf of our plan beneficiaries. So we pick up the quality of those. So very pleased, all of these over the quarter, the last year, and now over 3 years are positive, and we'll dive into some of those impacts in just a moment.
Jeff, does that, all that green, it seems like that's the first time I've ever seen every one of them is green.
It's not the first time, but the last time
Yeah.
was right before COVID struck.
Okay.
So
I was just wondering, is that somehow a one-off because of this market we've been through, or does that tell us something more strategic? Or are we still trying to figure that out,
Yeah.
what it really
No,
tells us, if anything?
That's a very good question. I am loath to suggest that sometimes they're all red, sometimes they're all green, but what we are trying to do is over long periods of time, make sure that they're green.
Right.
Right, so I'm very happy when they're green. And it reflects a lot of hard work from the people who are at their desks right now. But, you know, you gotta remain humble and you gotta make sure you're making long-term decisions. So I couldn't be happier with the returns, but I do not expect this to be the case all the time, by any stretch of the imagination.
They were all green in June too, just FYI.
I'm sorry?
They were all green in June as well.
Yeah.
From
Jeff,
Q1?
Yeah, from Q1.
Oh, got it,
Yeah,
got it.
yeah.
Jeff,
Yes, sir.
this is Ed. I have a question. Going back to those net benefit payments, what accounted for that sharp drop over the years from over $1 billion down to, what is it, 500 million? Well, what caused that sharp drop in net benefit payments?
And back in 2017, I think one of the most beneficial things that the General Assembly did as part of pension reform was to, significantly increase contributions. So the amount of money flowing into the trust, and both raising contributions both for the employee, but capping those at 9%, and then raising those for employers. Obviously we realize that those contribution amounts are difficult for our employers to pay, but that additional cash flow into the plan is really what that's the reasoning behind why that number has dropped so significantly. And because of that, that has significantly de-risks, there's a risk mitigating factor to that as well, which I think most notably, we experienced during March of 2020. Those additional contributions help us when, especially in a down market, when the lower the net negative benefit payments, then the less liquidity needs that you have, which really helps you in a significant market event like we had in March of 2020, because you don't have to sell things in order to pay benefits, because you have that cash flow to cover it. So that was a very, that, like I said, I think that's one of the most impactful things that the General Assembly's done to help shore up the fiscal infrastructure of the plan.
I think if you go back far enough in that, the conclusion of the Terry payouts is included in this illustration too, is that right?
The Terry payouts would have been considered a net
Right.
outflow of the system. I don't recall the amount.
And the last payments would have been made in 2018.
2018, okay.
So we've captured those in at least a 10-year annual.
So, Bill, if I come back to the question you asked, one of the things that I think is meaningful, and we always have to remain humble, but one thing that I think is really encouraging about the way that we've been investing more recently. So last fiscal year, the plan is up 28%, and we outperformed by, I forget the exactly, 3.7%. It was I thought that was a really meaningful outcome for us, especially in light of the struggles that we had in the prior fiscal year. This year, we're down. Markets are down, and we outperformed again. So I am most definitely not going to tell you that you should expect us to outperform by this magnitude all the time. But sometimes you just find that the decisions that you made several years ago are paying off. And sometimes it seems like everything that can go wrong goes wrong. So for the last 2 years, I don't think we got a whole lot smarter. I think we've done some things pretty well. We didn't see the benefit, but when you start looking over a longer period of time, I think you can start to feel better about the plan that we have and the way that we're managing it. So,
Yeah, thanks.
So let me move on from our framework and just review the performance of some asset classes here. And as a reminder, we simplified the portfolio, so we really, we have 2 years of performance since we've simplified the portfolio. So in the 3-year number, we're picking up that bad year I alluded to. But I think it's worthwhile to point out that, so we have 5 asset classes, plus we have our portable alpha implementation that we're showing here, net of the cash cost of our overlay. So we had 5 of our 6 asset classes we're showing you here add value during the year. The exception was real assets. And I'm going to walk you through in a minute the decisions that I made that prevented us from outperforming in all 6. Over the 3 years, you see 5 of 6 outperforming, the exception being private equity, and I think we've beaten that horse to death over the years. It takes a while to turn around a private equity portfolio. But I think that the things that are under our control and where we've been able to make important changes and employ more discipline with the way we do things, I think you can see that they're paying off. On that portable alpha hedge fund line, just as a reminder, this is net of a cash return, a LIBOR-based return for most periods. And so what you're seeing here is very simply, if the number is green, portable alpha is adding value. And if it is red, it is not. So it too, even though it's not officially one of our asset classes, has been performing quite well. So let me, we're going to talk about performance attribution now, and I want to just take a second to explain what this means. And when we talk performance attribution, what we're essentially trying to do is to create the bridge between our policy benchmark and our actual return. And the way that we do this is we rely on the investment decisions that get made to guide us from point A to point B. So the first of these effects that we're going to look at is allocation effect. And that is very simply where we overweight equities or underweight bonds, something very simple like that. Then we have the implementation effect, which I alluded to. We have baselines that guide our portfolio construction. The portfolio we are building to, in some cases, looks different than the benchmark. So what do we have kind of strategy-wise, and how does that differ from the benchmark that we have in the policy portfolio? We're going to be reviewing those effects as well. And then selection effect, that's very simply how well did our managers execute on that portfolio that we are trying to build. So these are the links in the chain, and we're going to walk through these quickly. But first, at a high level, you can see we start with our benchmark return of -5, and we end up, after we review these effects, down less than 1%. So let's go through them. First are the allocation effects. This is quite remarkable, I think, and I do not want you to expect this all the time. Every one of these effects is positive. Everything we were overweight outperformed the policy benchmark. Everything we were underweight underperformed the policy benchmark. So if you were overweight a good thing or underweight a bad thing, that contributes favorably to your outcome. And you can see that these impacts combined total 1.6% of that difference between the policy benchmark and the actual return. Then the implementation effect. This is where I alluded to some decisions that have impaired the return in our real assets portfolio. And I want to make sure I highlight these very clearly. Listed real estate, so think of that as REITs. Anything listed, especially in the back half of this year, has been beaten up pretty severely. REITs were beaten up basically just as badly as equities. And the reason we have this as a negative, even though we have a very small allocation to REITs, is the benchmark for real assets was up, I want to say 12% in the second half of this year. REITs were down 20. So before we even get into how did our managers do, that is a structural decision that we have made in our portfolio, or I made in our portfolio, to have some listed exposure. And in the 6 months that we just went through, that was let's just say that did not help. And then in our infrastructure portfolio, so that is one part listed securities and one part private infrastructure. And it did not keep pace with our core real estate benchmark that was up 12%. They were both down fairly meaningfully, or I should say, our private infrastructure did exactly what we'd expect, and it was more or less flat this year, the calendar year. The listed stuff was down, which again impairs our returns. So those are the detractors to our performance that really dinged us in that real assets return. Some things that we have that have been productive. We've had floating rate investment grade bonds in our bonds portfolio, so they obviously have outperformed as rates have risen. And this one is a little frustrating. Portable Alpha has been a fantastic success, but we are using to judge the decision to have Portable Alpha structurally according to how the universe of hedge funds performed. And it did not perform all that well, which brings me to the next page.
Can I stop you right there for a second?
Yes, sir.
I can't read, what's included in the infrastructure? Are those power and energy companies and?
Power, energy, midstream, think pipelines.
Okay.
Toll roads.
We don't have a whole lot of exposure to toll roads.
I don't have a lot of renewable either, but there's like
Yeah.
water.
You can have renewables, all kinds of utilities, water, electric, those types of things. Just power generation too.
Yeah, some of the data center exposures in there, so.
Okay, thanks.
So even though it might not look like Portable Alpha was productive, our actual execution of our hedge fund portfolio was absolutely fantastic. And therefore, it is a very meaningful contributor to our overall outcome. So I do want to, this is a little bit of a wrinkle. So real assets you see here is positive, even though I showed you it was negative. The negative aspect comes from the fact that we have listed exposures. And on this page, we basically use that as the shoving off point. Given that we have these listed exposures, how well did they do? So you can see that the job of our real assets team to go find the right managers, they did well. It was that structural inclusion of the listed exposures that wound up being not as productive. But you can see across the board, global equity is a passive exposure for us. Bonds is, Brian, would you say half passive? And then this is where we focus the overwhelming majority of our time and energy, and you can see that we've gotten some good outcomes there as well. And most notably, I think in here, private equity, which has been a detractor, has been slowly coming back to the pack, and here for the fiscal year actually outperformed. So we're very proud of the changes that we've made there as well. So back to this, that is how we walk from down 5 to down a little less than 1%. I'm not going to stop here, but this is the heat map. And since we have some new faces, this is the easiest place to see if there's a question that needs to be asked. So anything that is bright red or bright blue is something that we typically touch on. But we are summarizing the allocation effects, the implementation effects, and the selection effects, and totaling them here at the bottom. And now some portfolio positioning changes. After a quarter like we had in June, where the public markets really took a beating, there's some rebalancing activity that needs to take place, because we do rebalance with discipline. So we we found ourselves adding $900 million to public equities for reasons hopefully that are fairly obvious. We added $100 million to our REIT portfolio in light of the fact that it was beaten up so badly. What I don't have shown here is we redeemed from the core real estate funds that performed very well, frankly, over the last 2 years. In our bonds portfolio, given that we remain underweight, what we did was we extended duration in order to offset part of the magnitude of our underweight. We are underweight simply because we are overweight other asset classes. Then in private equity, on the next slide, I'm going to show you the magnitude of our overweight. I think it's worth pausing and reflecting on how we got there. Private equity has outperformed the rest of the plan's return by 24% annualized over the last 2 years. So I'm going to ask you to keep that in mind when you see that where we are relative to our allowable range. Private debt has continued to perform quite well, so we continue to be overweight there. And our portable alpha hedge funds, one of the tests that I think is important is whether or not we are seeing market exposure smuggled into that portfolio and called alpha. So when markets are down and that portfolio is up, I think we have answered that question. So here we are at our compliance stop on the journey. Our private equity portfolio is currently at nearly 15%. You can see over here the allowable range is 13%. So we are out of compliance with that right now. And also we do have and that is a notification that I have to provide at each meeting to the commission as long as we are out of compliance. And we also we track where are we overall with total private markets, and given the size of that overweight, and we do have overweight to private debt and real assets, we are significantly overweight our target right now. I just want to make sure that everyone has clarity on that.
Jeff, not that we could do a whole lot about it because private equity is a liquid instrument. What additional risk are we taking on by being in this position rather than being in compliance?
So we typically think of the types of risk, just more volatility in the plan being one, but we also we spend a lot of time thinking about the key risk to us that can affect how we can manage the plan in the future is liquidity risk. Mm-hmm. So we are absolutely tying up liquidity when we have private assets, but we do not have a challenge managing that situation. So I want to raise that as a question, but then deal with that very clearly. We have considerable flexibility with respect to our liquidity in the plan, and I'm not just talking about our ability to go raid the cupboard that is the bonds portfolio. We have other ways that we can create liquidity as well. So I don't have concern about our liquidity challenge.
Jeff, you are not. I'm sorry, Bill. I was just going to say you're not alone in that regard either. If you look across your peers, they're all dealing with this. With private equity having had such strong returns over the last couple of years relative to the other asset classes. Your problem might be a little bit more pronounced because your private equity has performed even better than the average public fund, but everybody's dealing with that, and that's one of the things that Mike and Jeff have put on our agenda is to look at your current ranges and see what the fact that should we expand those ranges, number one, and two, what would the impact of that be from a risk perspective, whether it's looking at volatility or whether it's looking at illiquidity risk in the portfolio. So that's something that we have on our agenda to look at the upcoming meeting. Sorry.
Mr. Condon?
Yeah, Jeff, on the earlier slide, you said since June 30th or so, you've invested, I think, $1 billion. And global equity and,
Yes.
and real estate. Where'd that money come from?
So we took, I don't want to name specific managers, but,
Okay.
but we were meaningfully overweight our real assets portfolio. So we took a healthy amount from our core strategies, which had performed very well relative to what we see happening in the listed markets. So we were able to sell high, buy low. We also, when I describe what we did in the bonds portfolio, we funded from bonds, a portion of that as well. And that's why we pushed to extend our duration.
Okay.
In order to mimic a larger bonds allocation. Because the bonds portfolio, it's not there to earn 7%. It's there, very much there as a diversifier in normal times, even though it hasn't been diversifying this year. But we did extend the duration in order to give our 19% allocation to bonds a footprint that resembles, from a duration perspective, more of a 22 to 23% footprint. We're trying to make sure that we're honoring the reason why bonds are in the portfolio in the first place.
Okay, thanks.
Mike, I have a question on that very point of the extended duration. Are we giving up anything by extending duration because of the high rates of what's happening in the short end of the market? I mean, you got a 1-year Treasury bill at over 3.5% now.
Yeah, so that's a good question, Ed. I'd ask you to think about the bonds portfolio. Bonds portfolio is really not here for current yield given these current yield levels. The bonds portfolio we go back to our asset allocation. It's in the portfolio because we need an asset class that typically, when stocks are down, there's a flight to quality, and the bonds portfolio would benefit. So we're chasing that type of purpose for that allocation. Now, obviously, what we've seen this year is rising interest rates is obviously no good for bonds, and has been no good for equities either. So if rising rates are the cause of the turmoil, we're unlikely to see that same kind of diversification benefit. But we're trying to be faithful to the target portfolio, the policy portfolio, in having that allocation and giving it a specific purpose. So I don't know if that's satisfactory, but yeah.
I guess the question I have is if you want to rebalance away from bonds, can't you do that in the short end of the market as opposed to extending duration?
Yes, and Ed, that's effectively what we did. Was we reduced our exposure to 2 years and reallocated across the curve while actually taking money or exposure off the table, in essence. And we did this in our overlay program. Okay. All right. Are there any other questions on, I have one more or two more slides, our portfolio risk estimates. I'm going to jump to the next page to do this. So we track two flavors of risk. One is forward-looking risk, which is how do we believe assets will perform in the future relative to each other. And then we have historical risk, which actually measures the changes in our portfolio. So you're not as likely to see significant changes in the top row relative to the bottom row, but we do try to make them both very sensitive to what are the actual levels of risk we're seeing in the marketplace. So needless to say, after a quarter like we just had, these numbers are higher. The highest number, the greatest increase affects the reference portfolio, followed by the actual portfolio. The policy portfolio and the implementation portfolio saw less meaningful increases, and similar very much the same story in our historical risk. And the thing that I do like to point out is that the way that we think about risk in terms of how we invest is driven more off of the top row than the bottom row. Woe be unto the investor that underestimates the risk. So hopefully you take some comfort in, we believe that the way that we are investing differently, we have eyes wide open about the risk level. And the most meaningful driver of elevated risk that you see to the right of the policy portfolio on top is coming from the fact that we have been overweight private equity and underweight bonds. And that is, if you think about it very simply, overweight the thing that you should expect to be the riskiest in this portfolio, and underweight the thing that you should expect to have the lowest volatility over long periods of time. So that is the lion's share of the elevation of risk that's in the portfolio today. Even though on a historical return basis, you don't see it playing out that way. We still choose to approach it this way so that we're eyes wide open about all risks. So let me pause there and see if there are any questions. If not, let me turn it over to Mark. I think you have some things you'd like to add.
Well, before we go with Mark, Mr. Conner, did you have a question?
Yeah, more of it's just a comment. Thank you, Mr. Chairman. You know, just a thought, I mean, we don't have to get into a discussion or anything, but so as I think Jeff said earlier in the day, you know, the reference portfolio, we picked, the commission picked the policy portfolio to have similar risk to the reference portfolio.
Yes.
Looks kind of similar up there in the forward. But of course, and Jeff was describing it, maybe primarily because of the overweight right now to private equity, our implementation and actual are, I would say, significantly above the policy. So we know why. I'm just thinking from a control perspective, and this is where I don't really have an answer.
Yeah.
From a control perspective, you know, we wanted, of course, we've allowed you to do it, so, you know, we sponsor it. But I just wonder how far we as the board want that risk to go up, and when does it become concerning? And I guess it's already concerning, because as you said, we should always pay attention to risk. I'm just trying to put these thoughts together in my head.
Yeah, sure. You mind, can I jump in there real quick?
Of course.
I think one of the ways that you exercise a degree of control, right, is, all of the asset classes have ranges, right? And those, because ultimately what's going to drive primarily going to drive the difference in risk between the policy and the implementation and the actual is how the portfolio is tilted to asset classes that have more risk, right? So and that's also why one of the reasons with the private equity portfolio that we've asked Mark and Mike to take a look at, the ranges around both the target and the ranges around private equity, for instance, and I think the thing that I would suggest that you want to see is, to the extent that we are ultimately that we're taking more risk, that risk is efficient regarding the amount of return that we would expect to generate as a result of that additional risk, right? Because taking more risk and earning the same return isn't efficient. But if you're taking more risk, we're obviously taking more risk on a forward-looking basis. And, some of that is, I can tell you, the way that we proxy risk is to be conservative in the amount for us to be conservative in our expectations as to how risky things are, which means we're punishing those private asset classes more than we necessarily would or could in the way that we pick the proxies and how that all gets into the mix. But what you see when you, in kind of that backward-looking basis, when we're looking in the rear view, is that doesn't necessarily play out. But some of that is a result of private equity only marks, once a quarter. There's some of that at play as well. So in essence, what we're trying to do is we're trying to balance that look forward and then that rear view and is, like compensating for the two. But, if you think, looking in the rear view, the historical risk of the reference portfolio, the actual risk is less, but then we outperformed, over that time period that this is looking back at by 190 basis points, right? So, I think the other thing that we gotta be careful of too is none of this is an exact science, right? So, I think creating some expectation that, it's not that what you see in the forward-looking risk, I'm not gonna say that it's wrong, but it's also not the only way that you can do it, right? So, but Mark,
I was just gonna say, I think, Bill, you're asking the right question, and that is exactly what we're gonna be looking at as we look at what is the appropriate range around private equity. Because the one thing you don't want to be a forced seller of private equity, where you're gonna take a haircut of 20% or more or less, depending on the market. And I think to Mike's point, it's almost always the case that any kind of forward-looking risk that we assign to private equity is higher than what you actually experience in reality. Reality is a general term, because as we know, private equity, we have lagged valuations, we have, they're not marked to market, so you don't actually see the volatility that we model in reality. So that, as Mike said, it's a balancing act between the two. And so what we're gonna come back, I think the biggest risk that you face with the higher allocation, it's not so much the volatility, but it's the illiquidity. And so that's the one thing that we want to look at is can your plan withstand that? Because if you have the liquidity embedded in the plan to ride out a market downturn, then I'm not concerned about short-term volatility, or not as concerned about short-term volatility. So those are the two primary factors we're going to be looking at in December.
Okay.
All right, Mr. Brubaker, was there anything else you wanted to add, since I think Jeff was in the process of turning the discussion over to you on this to wrap up?
I just to provide a little some perspective, and Jeff touched on the diversification in the plan. I think when you look at the fiscal year 2022, all of the public asset classes were down. You saw your public equities down 16%. Bonds had one of their worst years, down over 10%. And yet you generated a return that was almost flat. And that's primarily, you saw, due to your diversification in the private asset classes. But even within, you saw your fixed income portfolio outperform by 2.5% because of the diversity within that portfolio. So I think diversification was one of the keys to your outperformance. The other thing that I would note, I thought that this report was really clear. I liked how we walked through each decision factor and, what were the board's decisions and what were staff's decisions, and breaking that down. I like the fact that we aren't benchmarking or comparing to peers, but I do think it's worth noting that your performance for fiscal year 22 ranks well in the top decile of your peer group. For that fiscal year. The median return was down 7.5% to 8%. And the other thing I would note that was unique really over the last 2 years when you look across the public peer universe is the dispersion between the top performing funds and the bottom performing funds was probably as wide as it has been in a long time, both in fiscal year 2022 and in fiscal year 2021. And the primary reason for that was private markets. Private equity in particular, not just the allocation. So those that had higher allocations to private equity generally did better. Those that didn't did worse. But then within private equity itself, the dispersion of returns were quite broad. So those that had strong private equity returns did better than those that did worse. And the margin was meaningful. I think RSIC was very fortunate in both categories. I think you had a slightly higher than average allocation and better than average performance. And I think all of those things, plus the diversification, really added up to not only generating strong returns relative to your benchmark in a very difficult market, but strong returns relative to your peer group as well.
Any more questions about our performance recap by our CIO and our consultant at this point. Jeff, you got anything else, or does that conclude the?
I do have the delegated investment report.
All right, yeah, that's next on the agenda.
According to policy, we reveal at each meeting actions taken since the prior meeting, and we did make 5 investments using the delegated authority that we have, and commissioners, of course, received and have access to the materials, but I am happy to take any questions and funnel them to Brian Moore. So if you'd like any more detail, either now or afterwards, we're happy to provide it. But Mr. Chairman, that concludes
All right.
the presentation.
All right, Mike.
Thank you, Mr. Chairman, if I may. Just wanted to start out by saying this is somewhat of a bittersweet day for me personally. I just, as of last Friday, celebrated my 8th year with the commission, which is somewhat of a milestone. And it's sweet in the sense that this is the first meeting where I get to welcome 2 new, very capable commissioners. But it's also bitter in the sense that for all of those 8 years, the 2 folks that you see standing here have been such an integral part of my life as a CEO of the Investment Commission. And I can't say enough to thank them for everything that they've done, Dr. Ron Wilder and Dr. Rebecca Lawson. Both Ron and Rebecca were there from the very beginning. I can't tell you how much their work, both individually and collectively, has contributed to the changes that we've been able to make to the commission over the course of the past 8 years and during the term of their service. They have spent countless hours with us, helping us figure out the right path, and both have served as chair and vice chair of the commission respectively, and have just did an incredible job for us. And I can't thank them enough for everything that they've done for the commission. I know that they were hoping to spend a peaceful September without having to show up at one of these, but we would certainly be remiss if we did not. Pull you back in. If we did not welcome them back and thank them for everything that they've done on behalf of the commission. The old adage is always leave something better than you found it. I can say that both of them have exceeded that guidance and what they've done for the commission, and although they have left us, they have certainly left the commission much, much better than they found it. So thank you, Rebecca. Thank you, Ron, for everything that you've done. We have some tokens to commemorate your service. Both tokens. Of you, we have the state flags. And we have certificates for both of you that those flags were flown over the State House in honor of your service to the commission. So, again, thank you so much for everything that you've done for us. Certainly open it up to anybody else who would want to add anything. But thank you.
I'd just like to say it's going to be hard being the only economist on the
We're 50% down economists.
Well, I feel you were overly generous with your comments, but they're very, very much appreciated. I will say the one thing you nailed is that we have left this place a lot better than we found it, but I don't think it's because of me necessarily. It's really because of you and Jeff and the incredible staff that has really just transformed this place into really the best practice for the nation in terms of pension investment commissions. So I really feel very honored and lucky to have been able to serve with all of you and partaken in this. So thank you very much.
Thank you.
Yes, and I echo all of Rebecca's comments. I'm reminded of the old Greek philosopher, that said you can't step in the same river twice because you change and the river changes. And as Rebecca pointed out, the river, that is RSIC, has changed a tremendous amount. And I too am grateful for the leadership of my fellow commissioners, for the staff, Mike, Jeff, Brian, James, Robert, everyone else on the staff, Betsy, and others that I didn't name. Grateful to all of you for your support and leadership. Thank you very much.
We're at a break. I'm gonna resume here. Next item on the agenda is to recede into executive session, and we will need a motion to do that. Mike, can I get you to read that for us, please?
Yes, sir. The motion be to recede into executive session to discuss investment matters pursuant to SC Code annotated sections 9-16-80 and 9-16-320, including particular matters related to the public equity and Portable Alpha portfolios, to discuss personnel matters pursuant to SC Code annotated section 30-4-70, and to receive advice from legal counsel pursuant to SC Code section 30-4-70A2.
May I have a motion to that effect?
So moved.
I have a motion. Do I have a second?
Second.
I have a motion and a second. Do you have any discussion before we call a vote? No discussion. All in favor of receding into executive session, please say aye.
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 Any opposed, please say no. The ayes have it.